Welcome to a new episode at Economics Design. Today we're going to cover our last protocol in the DeFi series of options. Remember, January and February we're covering options, and so we're going to finish the last week of February with options protocol. And today we're going to cover Opyn. And Opyn it's very interesting because it is the first options protocol in the DeFi space, and they're growing tremendously since. So we're going to cover them today. Before I begin, none of this is investment advice. This is purely educational to teach you how the different protocols work and also to give you some idea and insights of the economics that goes around when creating and using these systems. We're going to cover 5 things today. What is Opyn? How the contracts are created, how the contracts are traded, the mechanism design as well as the token design of Opyn. So firstly, what is Opyn? Opyn is an options platform. It is the first options platform in the DeFi space. It uses this protocol called Convexity Protocol, and you can find them online. How options how are they different from the rest is that you can generally trade this options contract. In the other different kind of option contracts that we have chatted about, in general, they're being priced. You pay a premium as a buyer, and you can either execute them on expiry, or you can execute them before expiry. So these are how oTokens or how tokens are being traded, and they represent options. So for example, if I'm buying a put or call options for ETH, my underlying is ETH, it will create an oToken, so the option version of this ETH with the strike price and the expiry that I'm looking for, and then I can buy them. I can either create them and hold on to them, or I can buy them in secondary market. So that's one of the biggest difference between all the other protocols. How you can buy these ETH, or how you can buy this options ETH, the oETH, is either in Uniswap in version 1, or they recently upgraded to version 2 using 0x protocol. So we're going to talk about that a bit later. Why is this good? It's good because this allows for price discovery, which is very important when we look at options. One of the ways that options are very powerful in the space is because you have price discovery as the option reaches maturity. So before the option expires, there is value in that. You can trade this asset and make money out of it. So that's why you have option traders. Option traders are not just writing contracts and then waiting for it to expire and then executing them. You can make money trading these option contracts instead of holding the underlying. So that's why it's very powerful and very interesting, and I want to talk a little bit more about it. So let's get started with how do we create oTokens. Opyn version 1 and Opyn version 2 are quite different in the way these option contracts are being created. So in version 1, you go to opyn.co, and there you see that you can either buy tokens or sell tokens. So you go into there, they show you different types of options. So you can buy USDC, you can buy Uni, you can buy put or call, you can buy rep BTC. There are a few assets for you to play around with. And you buy them with USDC. So you can buy or sell protection. And if you're selling, you get to earn premiums. If you're buying, you pay the premiums. So that in general is how these oTokens are being created. What about version 2? Version 2 is slightly different, where you go to the 0x protocol and you can go to the protocol and purchase these option assets. And you can also create them under the trade function. So it uses, the concepts are both the same, as in you put in your strike, you put in your strike price, you put in the expiry, how long you want these options to last for, and then the oTokens, the oETH or the O whatever asset will be minted, in which you will pay the different premium. So that is how it's being created. What about being traded? Being traded is a lot more interesting because it opens up the conversation of price discovery that we talked about. So if you go to the website, you will see that there is this Opyn monitor for version 1. It uses Uniswap. So you can either go to Uniswap to look for it, or I just go directly to the options platform. So it's opynmonitor.xyz. There you have the different kind of assets available that's available. You have rep BTC and Uni for now. You have the different expiry dates, which is the last Friday of every month. And then you have the different strike price, the expiry, the open interest, the implied volatility, all the other stuff, and you can trade there. So this is the version 1 option. or the version 1 alternative, where you can buy and sell and trade them via Uniswap. And this is done where Uniswap has a pool, and you have both different kind of, you have the options protocol in there, and you have USDC, which is the liquid asset, and then you can trade them, and that's how you get different price discovery. So that's what they're doing for version 1. Version 2 is different. Version 2, you go to Gamma Protocol, portal.xyz. There you go to trade, you go to order book. So this is where it becomes quite different, because version 1 uses AMMs, so decentralized exchanges, the concept of bonding curves to be pricing assets. In version 2, it uses 0x protocol, and it uses an order book, so the central limit order book the usual way. So as you can see, the tables that's being created is very similar to the traditional way options are being traded anyway. So you can look at the call, the put, the different bids, the different implied volatility, which actually changes, and the different price for it. So you can just purchase them accordingly to your needs. So that is how they're being traded in version 1 and version 2. They're slightly different. So one of the biggest problems that I asked Opyn is liquidity, because liquidity is massive. When we talk about decentralized systems, we want to talk about the death of liquidity, because without liquidity, you can't buy or sell. Yeah, without anyone supplying the liquidity asset or the liquid side of options, you can't buy them. So how is Opyn dealing with that? So there are two ways they're dealing with it. The first one is a short-term method, which is limiting the amount of strikes trading until there's liquidity. So as more people are adding ETH, and from there you can create oETH, so the options version of ETH, then you can be creating more option contracts that people can trade, right? So how they do this is they need 160% of collaterals. So $160 worth of ETH to be creating $100 worth of ETH option contracts. So that's how they're dealing with it. In the long run, though, that's not very scalable, right? So in the long run, what they're creating an AMM. So an AMM that has two assets. So you have ETH and USDC in there. And instead of trading USDC and ETH, it trades USDC as well as the option versions of ETH. And this can be very versatile, because you don't need to have specific strike price, a specific expiry, which is the situation right now with Uniswap. Now you can create any strike price, any parameters that you want, and this can be the pool itself will be minting the ETH option contract, and you can be trading it with USDC. So this way we're pricing in volatility. We are also getting price discovery for the option asset. So think about how we talked about Hedgic last time. Hedgic is really a one-sided asset. You put ETH in, and based on that, anytime someone wants to buy the ETH contract or ETH option contract, we put in the strike, we put in the expiry, and then it mints the option, and we can hold it. That's how we get exposure to the options contract of ETH. What they're doing is upgrading the system, but instead of just putting ETH in there, you also put USDC. So USDC will be the pricing model of these ETH assets. So that is what they're doing in the long run, which is very interesting because it's combining a lot of different concepts that we have in place. So we have the concepts of Uniswap, we have the concept of hedging, we have the concept of creating options, which is what they have been doing already. Put them all together and allow them to interact with each other to be creating a more robust pricing model for these option contracts, which really goes back to the concept of how everything in DeFi is Lego, right? You have Lego bricks from Uniswap, you have Lego bricks from options, you have Lego bricks from Hedgic, you have different kind of Lego bricks, put them together, and you form a whole new method, a whole new mechanism involved. And that's why DeFi is so fun. Talking about mechanism, let's dive into the mechanism design. Remember, in the token economics framework or the economics design framework, we're looking at 3 different pillars: market design, mechanism design, as well as token design. Market design is the environment which tokens and participants will interact with. We don't want to talk so much about that because I'm sure you can find all the different data. I want to give you the key information that you need. Mechanism design is the different rules that the rules and structure that the ecosystem has to play by. Token design is the rules of the tokens itself. So let's get started with mechanism design. In mechanism design, one of the biggest things is governance. And in governance, I split them into two. One is how decision is being made, which is very important in governance. And the second thing is resolution. So if things go south, that's where governance is for, right? But they're not exactly part of decision making, they're part of resolution. So in governance, it's decision making and resolution. So for governance in Opyn, right now it's being managed by the core team. Soon they will decentralize it, but once it's a little bit more stable, which completely makes sense because derivatives or options are very complicated products. You don't want to start decentralizing it from day one and you have the governance or decision making given to people who don't understand derivatives at all. So this is important to be managed by a core team to get the things up and running. Then it's distributed to the different kind of community members. Of course, that means that there is some limitations to what they can do. So for example, they can whitelist assets, but they cannot have access to the funds, which makes complete sense. The other thing is resolution mechanisms. So there are different types of users in the space, right? Different kind of functions. So you have the owner, so they can whitelist or blacklist the collaterals. You have the pauser. Pauser is someone who pauses the entire operations. So it could be emergency pauses or partial pauses because there's huge volatility in the market and you need a break. This makes sense because in the S&P, in the New York Stock Exchange, this happens. It's automatic. When there's too much volatility, too much fluctuation in prices, trading stops for 15 minutes, okay? So it's not something very novel. It's something very important that we have to think about when we're trading these kind of more complicated, sophisticated products. Then you have pricer, so submitting prices, and farmers, yield farming, you get any balance and get any gains from the system. So that's how governance works. When it comes to non-financial incentives, what we're looking at is how the rules of the game, right? So the rules of how the system works. So one of the rules is closing your position. So to close your position, in version 1 at least, you have how option tokens are traded. It's that let's say you have oETH, you have a put, or let's say a call. Okay, so oETH, you have call because you're bullish, and you're thinking of a strike price of 3,000, so ETH will go to $3,000 in a month. So these 4 parameters, and you put them into a token, so oETH token, and they are traded in Uniswap. So it has, in the Uniswap pool, you have USDC as well as oETH, and they're traded. So what you can do is, if you want to remove your position, you want to close this, then you will buy all the oETH, you will buy up the collateral so that, or you buy up all the assets in the vault so that you own all of them, and then you burn the oETH and you redeem all the collaterals. So that is one method to close them. So you need to completely clean out the vault. In version 2, because version 1 is physically delivered. Remember we had a conversation about that like a couple of months ago with the CoinFlex team. Physically delivered means I actually have to give you my ETH when you want to execute your oETH contract, and you give me your USDC. What cash delivered means that we don't care about the exchanging the ETH itself, because once I get your ETH, I'm going to sell it for money anyway. So let's do a cash settle. What is the value of ETH now? And then we price that in USDC. You have to give me USDC instead. We find out what the difference is, and then we just repay each other the difference. So this is what it's doing in version 2. That's how you're going to close your position. So that's one of the differences between version 1 and version 2. Now, what about token design? Token design, let's go back to how the tokens are being minted in version 1. So version 1, it is minted with a smart contract using 160% in collaterals. How it works is that I am a seller and I have ETH. I want to sell ETH options. So I put my ETH in a vault, and the vault will be creating oTokens. So oTokens, again, $160 worth of ETH, and then it creates $100 worth of oTokens. The oTokens, these oTokens will be oETH. They're minted and then they're traded on Uniswap. Of course, when they're minted, they're going to be minted with specific expiry as well as specific price, as we mentioned before. So this will be very, very specific, because ETH put at 3,000 expiry in 1 month and ETH put at $3,200 expiring in 1 month are two very different assets. So this is two different Uniswap pools. That's just the concept, right? And how it works is that me, because I am putting my ETH in there, I'm owning the vault, then I get to earn transaction fees when things are being traded on the Uniswap pool. And I also get to earn premiums when people are purchasing the oTokens. Because as an option seller, remember we talked about this a long time ago, why do people want to be option sellers? Because they get to earn premiums. So if anyone buys the oTokens from me, because I'm selling it, I'm the seller, then I get to keep the premiums as well. So this is the mechanism of how it works in version 1. In version 2, the difference is that it's cash settled in using the centralized or the order book method. So it's matching the different kind of orders. That's how you get price discovery as well. Once again, oTokens are minted. So when you put ETH in, it mints out oETH that can be traded in the centralized order book method. And then they're traded in the Gamma portal that you see the table above. So one of the biggest difference between, what I'm diving deep into Opyn is really sharing the mechanisms. I know the last week I talked about the different strategies, right? And this is how strategies is one thing, the mechanism of the protocol is another thing. And once you understand how all these different things work, then you know that, okay, these are the strategies that I'm looking at, and I can use Opyn to execute these strategies. So for example, if you want, I talked about, when you're bullish, when you're bearish, and when you're pretty super bullish on the market, what are your strategies? The other strategy is a conservative one, where you're protective. So you sell a put at a higher strike, and then you sell a call at a higher strike, you buy a put at a lower strike, and you get to protect your asset by having against too much price volatility. So these are things that you can do on Opyn. Why do I say that? Because remember, you don't need to own the underlying asset, unlike the other protocols, because you can just buy the option contracts directly. So last week when I talked about strategies, the first two methods kind of more or less requires you to own the underlying asset, own the ETH. But what if you don't own the ETH? What if you just want to get exposure? And you can't exactly buy all these option contracts out there. You can buy them in OTC, but it's not really DeFi, right? So this is where Opyn comes in, and they talk a little bit more about the DeFi aspect of things. And you don't need to hold the underlying ETH. You can just go to Opyn and buy the option contracts instead, and trade the option contracts instead. And that's why I wanted to separate the conversation of strategies and how Opyn works. So going back to the topic of Opyn, what happens upon expiry in version 2? Firstly, we have in the AMM pool, you have USDC that provides liquidity. Once options expire, they're calculated in the cash dollars, which is also priced in USDC, and then the option is cash settled. So the good thing is that it's exercised automatically, and which is good because you don't have to figure out, I need to exercise it, or is it in the market? Do I exercise it, or do I forget about it and then I lose money after that? This is exercised automatically. It is priced automatically, and it will be settled between the buyers and sellers at expiry. So one of the other things that they're creating is that what you could do, we have perpetual futures. What we can also do is to create perpetual options, because when things are cash settled, a controller, a person that helps you to manage your funds in the Opyn protocol can be helping you to settle your option contracts in USDC, and then rolling this over to the next month. Now, this also goes into a deeper conversation, which is going to be very interesting if you're interested, because this comes into the understanding of VIX. So VIX is the volatility index, and what we are doing with perpetual options, where it's cash settled and the person can have, or the smart contract, or person can help you to manage your funds so that you can roll over to the next month and be selling options again. And this mechanism allows you to be a perpetual option seller. And from there, we can also abstract out the volatility of options and then create a volatility index out of it. So very big ideas, very interesting concepts. If you want to go deeper into that, this is something that is worthy to look into in the version 2 method. So that's all for this week. I hope that gives you a better understanding of what Opyn is, what Opyn does, and how you can use Opyn. You don't need to hold the underlying asset. You can just trade the option contracts instead and make money out of it. Or you can use it as a protective hedge or as an insurance, really up to you. So that's all for options. I realized that options is quite complicated. So what I'll do is probably next week, I will give you some time to go through all these different lessons that we have covered. And then I'm going to have a Clubhouse session where you can have your Q&A, ask me anything, and I'll try to bring different kind of option experts or these people who are creating the protocol to come in and have some discussions with you so that we can clarify some questions. I hope that's going to be more beneficial for you, and hopefully you get to understand options a bit better and make more educated understanding of how to use them instead of just gambling and speculating them, because that could work as well, gambling and speculating. But it's also good to be educated about your different kind of exposure as well as using options to manage your risk and hedge your risk. So that's all for this week. And do check out the token economics book that we have. Until then, I'll see you next week. Hopefully by then you have a better understanding of options and we will dive into new topics and new theme. Till then, see you. Bye.